All right, friends, welcome back to another episode of Reading Reviews by Ryan. Got a new addition to the merch today. I'm wearing a hat. Why am I wearing a hat? Well, it is 6:07 p.m. and I still have not showered. I did brush, but last night was one full of libations and hence, inevitably, an advanced state of inebriation. So I was drunk last night and I'm still recovering. But to be honest with you, no shame. You've been where I am before. You've been where I am, so you know what I'm saying. I wasn't going to do this, but the people have been asking. Aaron, I don't know which Aaron this is. I have a couple ideas. I'm trying to figure out which one it is. Shout out to you for commenting on my last video and saying, when's the next part? So, edge of your seat, I've been motivated by my OnlyFans swipe up to get this one in for the day. So I'm going to struggle through it, power through it. Also, another thing, what I've been banging my head against the keyboard about is, what do I call the fans, the nice 2 or 3 fans, consistent viewers that I have for Reading Reviews by Ryan? What do I call you guys? I was thinking Ryan's readers. But that sounds a little bit similar to like Scott's Tots from The Office. Don't like it. Sounds possessive. I don't know. Weird. So maybe just readers. But then, here's the thing too. Actually, you know what? Here's the thing. You're not even readers. That's why you're here. So you don't read. So you're not a reader. You're a leech. You're a leech, and you're just sitting there ingesting the knowledge because I read it. I'm the reader. You're the bum. I'll call you the bums. Anyway, if you've gotten to this point in the video, first of all, thank you. And leave a comment. Nah, don't do that. Don't leave a comment. All right. And let's get through part 2 of Burton Malkiel's A Random Walk Down Wall Street. So now this one talks about technical and fundamental analysis. These are 2 different ways. Formally, part 2 of this book is called How the Pros Play the Biggest Game in Town. So essentially what he's going to do is explain 2 ways in which professional investors, ones that work for hedge funds and stuff, look at the market and base their buys and sells off of that. So without further ado, let's get into it. All right, Chapter 5 is called Technical and Fundamental Analysis. We left off in Chapter 5. So these are the 2 ways in which my boy Burton here says the pros do it. Let's dive into it. Technical versus fundamental. So essentially, these are 2 methods of attempting to predict the future course of stock prices and thus the appropriate time to buy and or sell. If you recall last time, we had the castle in the air, and we also had the firm foundation theory, right? So technical analysis pretty much builds on the castles in the air. This is the one where we rely on what the people will buy, and we move with the masses, more of a psychological technique. And the fundamentals by the books, the firm foundation, we have to analyze the actual value of the stock compared to its share price. So in essence, technical analysis comes in the form of studying stock charts. And you try to deduce the different trends, and using the different trends, you see what's going to happen in the future because their idea is that history repeats itself, and that is all captured in the stock chart. Purely mathematical. Like I said, on an old startup, we did a lot of that. But it's tough. It's really, really tough. Even if you do have trends, it's still very tough. So essentially, they believe that the market is 10% logical and 90% psychological. So this kind of resonates with the CEO of that company I worked with. He was really into behavioral investing because the market is the people, and people are stupid. No offense. I mean, I'm in that boat. I'm stupid. So that's that. Fundamental analysis, old school. Flip that around. We're 90% logical, or the market is 90% logical and 10% psychological. So like I said, it seeks to determine the stock's proper value And proper value comes from the company's assets. Huge one here, the expected growth rate and earnings and dividends. And there's also the interest rates and the risk of that stock. All right, so a little bit further in depth of the technical analysis. There's two principles. One is that all the information I just said, the assets, expected growth rates, interest rates, whatever, risk, the technicians claim that all of this information is inherently and automatically captured in the stock chart. That includes the historical prices as well as the trading volume for every day. And that kind of makes sense. The stock price is reactive of what the people are. And if you believe that people are doing their due diligence, then these people are well informed. So then inherently, the stock price reflects all of that stuff. The second principle is that prices move in trends. There's momentum. What I've called it price inertia. Yeah. So basically, it's if your prices that are increasing tend to increase, prices that are stagnant tend to stay the same, prices that are decreasing tend to decrease. It's very rare, although these days it's more prevalent, to see like either a super steep drop or a super steep spike. But this is the danger, is because the stock price, doesn't matter what kind of time series you're using or Fourier analysis, how do you predict the black swan? The black swan is like that one event that's never been seen before, and then all of a sudden it comes in, and you can't expect that. You can't see that from historical trends, aka, let's say, COVID, a pandemic. We didn't know that. These people, by the way, that say, oh yeah, we've been worrying about a pandemic for years. We predicted that it would come soon enough. Anybody could say that about anything. I predict that there's going to be an accident on 275 right here at some point in the next week. Boom. Okay, put me on a headline. I digress. Is it bright in here or is it just me? So what's interesting is that technical analysis does not care about the industry or the company. So a stock trend at Walmart is no different if you're just looking at the charts as a stock trend at, like, let's say, Tesla. Completely different industries, but if their stock charts look the same, which they don't, that was just an example, that's all they look at. They don't care about the company. So one of the cons of this, though, is that you're inherently reactive. So by the time an upward trend is signaled, it may have already taken place. And trust me, my friends, take it from my experience that this happens because I was looking at Apple, bought Apple stocks anticipating that the price would spike because of the 1-to-4 split, which honestly has no merits. It doesn't change anything. I thought of the psychological thing. Oh, the price is going to drop, so people are going to want to buy even though they could have already because of fractional shares. It's been going down. I've been losing money. I digress. Fundamental analysis. What is the stock really worth? By the books, not what people value it, but what is it valued based on what it has. Assets, expected growth rate, everything that's actually happening. So this one aims to be immune to the crowd hype and establishes a stark distinction between current price and the true value. And of course here, industry matters. He gives 3 rules. Rule number 1 says the following. A rational investor should be willing to pay a higher price for a share the larger the growth rate of dividends and earnings. So basically, if you anticipate that this is going to grow, you would logically pay more for it, but this has to be well established. So that kind of brings us to the PE ratio. I think I might have mentioned this last video, but we'll gloss over it now. Basically, PE, price to earnings, price of the share, earnings per share. Essentially, how much am I paying for $1 of earnings per share? So let's say the share price is $30 and the earnings is $1 per share. That means the PE ratio, obviously, can we do the math here? Is 30. The PE multiple is 30. That means I'm paying $30 per $1 earned of this share. A high PE ratio is usually associated with a high expected growth rate.
Now, in my first year of grad school, I walked into this portfolio management class, highly mathematical. I was lost, right? And he had us do a presentation, and I panicked. However, I analyzed Netflix at the time. That was 2017, the end of 2017. And the PE ratio was probably like 50-60. And the stock price, I believe then, was around 300. And so I said, based off everything that it's planning to expand on, I would buy this. Definitely I would buy this. And then one of my classmates beat me almost to death in an argument, not an argument. I succumbed because I was nervous anyway, so I didn't know what I was really talking about. And she was like, why would you pay $300 for that when you could pay like $50 for this stock? Now the stock is like 500 something. Damn, I wish I bought that. I digress. Rule 2. All things equal, if one stock pays more dividends than another, go with the one with the higher dividends. The caveat here is all things equal. Rule 3, all things equal, get the less risky stock. I mean, that's I don't have to explain that. The best thing to do is to use fundamental and technical analysis together because each have their pitfalls, but perhaps they can make up for one another in these, right? So he gives 3 rules. Train is coming. So like I said, he gives 3 rules, and 2 out of 3 of these are fundamental analysis, and then the third one is the technical analysis part. So it's a nice, healthy balance between that I think makes sense. First rule is buy only companies that are expected to have above average earnings growth for 5 or more years. Rule number 2 is never pay more for a stock than its firm foundation of value. Again, fundamental analysis. So generally, he says, the earnings multiple for the market as a whole is a helpful benchmark. This is the PE thing I was talking to you about. So for certain types of stocks, if they're classified as this, look up the typical PE multiple. And if it's higher than that, you don't want to do it. If it's lower, then you consider that a value investment because you know that the efficient market hypothesis will raise that up and you will make bank. The third one is look for stocks whose stories of anticipated growth are of the kind on which investors can build castles on the air. So it's a good story, but it actually has the potential to succeed and make money for you. So successful investing demands both intellectual and psychological acuteness. Boom. Chapter 6 is called Technical Analysis and Random Walk Theory. And pretty much what this is 25 or so pages of my boy Burton just bashing on technical analysis. Bottom line of this chapter is that it is absolute horse snob, right? And we can get into the mathematics of it, but really, here's his overall view. The history of stock price movements contains no useful information that will enable an investor consistently to outperform a buy and hold strategy in managing a portfolio. Keyword here is consistently. A very good point that he made is that most advocates of technical analysis usually fail to test their schemes with market data derived from periods other than those during which the scheme was developed. So you're basically just documenting its successes, but you haven't tried in other parts where it probably would have failed. And another thing to note is on these technical analyses, let's say I'm day trading. I don't know exactly how that process works, but I do know that the tax brackets on capital gains significantly drops if you have held that stock for a year or longer. So if you're trying to trade every single day, if you're making hella money, great, but you're going to get shafted from the taxes. You can't forget about that. But I think most people do. So he says, all that can be said is that the small amount of information contained in stock market pricing patterns has not been shown to be sufficient to overcome the transaction costs and taxes involved in acting on that information. Funny quote here. Richard Quant says, technical analysis is akin to astrology and every bit as scientific. Now, if you're sitting there saying, whoa, there was a full moon last night and I was in an extra good mood and I was tingling, then you might be one to do technical analysis. I don't know what to tell you. But what's really cool about this, and this resonated with me, it caught my attention because I've seen it in another book. I forgot which book, but it was describing like mathematics in real life. This one talks about randomness and about hot streaks. So the hot hand is a common thing to talk about, like in basketball, for example. So when I'm running down, we're playing fives down at Hyde Park, and I'm wetting them threes. It's pouring out. 10 in a row. I'm led to believe, everybody says, it's the hot hand. This is my celebration. Damn, the thing is getting this third degree, you know? The thing is, let's think about coin flips. 50-50 chance, right? There are times where you have 10 heads in a row. 10 tails in a row. But for the most part, it's fluctuating in small numbers, and it looks like a stock chart. So the reality is there's no such thing about the past 3 shots making you continue to make shots. Actually, I think it actually does the opposite. If I make 3 in a row, my confidence is high, so I might try to make a stupid-ass shot. So actually on my 4th shot, I'm more likely to miss it because of overconfidence. The point is, people remember hot streaks and cold streaks more, and psychologists say that this is due to memory bias because it's more memorable to think of 10 shots in a row rather than in a course of 20 shots, you make 10 scattered around. Bottom line, technical analysis, he don't like it. Man, I don't even know if it's worth going through the rest of this book because literally we can go through all this and we can see how the stock market works. But to be dead honest with you, what he writes over and over and over is this. A strategy far more likely to be optimal is to buy the haystack itself. It's out of context. Buy an index fund, a fund that simply buys and holds all the stocks in a broad stock market index. Buy and hold a broad portfolio. Unmanaged, just let it sit because that will follow the market, and market trends are typically monotonically increasing over time. So after the COVID stuff is done, you'll see it start to incline again. So I'm starting to think that this might not even be worth it anymore. This is the book. This is the book. Warren Buffett even says that too. So why go through all of these 400 pages just for that? You know what? I'm going to call it. I'm going to call it. I had notes for this chapter. We don't need them. Base your portfolio off of index ETFs like S&P, like the VOO. That's an S&P 500 ETF. Load up your portfolio with that. I would say, who am I to tell you? I'm going 90% with that and then speculate on some other stuff so that you have a nice solid foundation and you could potentially have big wins or big losses, but that's okay. That's a risk you're willing to take. But you could have big wins, and that will supplement your portfolio. But you have this base that's continuously growing and these other parts that kind of move your portfolio up and down, but not as much as the solid market ETFs. I'm going to just call it for this book, and I hope you're okay with that. But that's literally, that's it. That's it. Okay. Well, I'll see you guys. And I'm not even being lazy. I'm just being for real. Why? In the part 4 is a practical guide for random walkers and other investors. What do you need? I mean, I guess you could do bonds and what does he have? Taxes, inflation, which I've mentioned, gold, projecting returns from stocks and bonds. Like, who's going to actually do this? A no-brainer step, investing in index funds. Okay, done. Said that. Potentially useful stock picking rules. Done. That's it. Okay? That's it. Literally, these last 2 things. Invest in index funds, potentially useful stock picking rules. Boom. I'm going to call it. I'll see y'all next week.